Hi everybody. Today I'm going to be talking about financial statements. By the end of this presentation, you should be able to list each of the key financial statements and why companies generate them, identify the information each type of financial statement provides to corporate managers and investors, and also explain why free cash flow has such an important effect on firm value. Financial statements are reports that are issued by a company in order to communicate their financial condition. They can be reported internally or externally and may be audited by a number of interested parties. These include government agencies, accountants, other firms, or stakeholders, and they are used to verify accuracy for tax purposes, financing, or investing potential. The average company reports a full set of financial statements every year. Financial statements are used to monitor businesses' ability to generate cash and also the sources of said cash and where that cash is being spent, to determine if a business is able to pay back its debts, to foresee any potential profitability issues that could impact the company's future, to predict the direction of a company's stock price, and to determine the overall financial health of a business. There are 4 types of financial statements. The first are balance sheets. The balance sheet, or statement of financial position, summarizes the assets, liabilities, and equity of a company in a given time frame. Its main purpose is to determine how liquid a business is. The exact items reported on a balance sheet depend on the industry and the company that is involved. But in general, line items included in the balance sheet are assets, which include cash, prepaid expenses, accounts receivable, inventory. Liabilities, which is accounts payable, accrued liabilities, taxes owed, debt owed, and shareholders' equity, which are stocks and earnings. Here is an example of what a balance sheet might look like for any company. The balance sheet lists assets on one side and liabilities and equities on the other. The most important part of a balance sheet is that the total of the right side and the left side are equal, highlighted here in red arrows. If not equal, the sheet is unbalanced and should not be released until the error is located and corrected. Income statements are also referred to as profit and loss statements or P&L statements. The purpose of an income statement is to report companies' financial activities in a given reporting period. This is the most commonly used of the financial statements and is often distributed within a company to keep management informed. Income statements often note revenue, the cost of goods sold, selling, general expenses and administrative expenses, operating incomes, income tax expenses, net income or net loss. The income statement may also report initial budgets in the areas listed and explanations for differences between what was budgeted and what are the actual results. Statements of stockholder equity or statements of retained earnings are one of the simpler documents. They report the change in retained earnings of a company after dividends paid to shareholders for a given period. This document is not usually included in internal financial statements as it does not reflect operational information. Here is an example of a statement of retained earnings. You'll see that the simplicity of it is that it reports the previous year's earnings, income, it subtracts dividends paid to shareholders, and reports the retained earnings at the end of the following year. The statement of cash flow reports the cash flows into and out of an organization. It focuses on the types of activities that create and expend cash. It is often considered the most transparent of all the financial documents and is used to determine the true performance of a business. The statement of cash flow is broken down into categories: operation activities, investment activities, and financing activities. Operating activities are revenue generating, and they include cash received for product sales, commissions, fines, lawsuits, supplier invoices, and payroll. Investing activities are payments made towards retaining assets or cash received from their sale, such as the purchase of fixed assets or equipment. Finance activities require reporting the equity of the business, such as the sale or repurchase company shares or dividend payments to shareholders. An important concept to remember when learning about cash flow is free cash flow. Free cash flow is a means of dynamically measuring the amount of funds that can be withdrawn from a business or paid into the business without hindering its ability to operate. It can be used to understand the true profitability of a business because it is a much harder metric to manipulate than an income statement. Income statements are designed to smooth out a business cash expenditures over time. Free cash flow is a snapshot of the current statement of a company. Many people use this when valuing business. If you are interested in any of the topics I've discussed and would like to investigate further, you could look into these questions. What are the differences between the income statement and the statement of cash flow? And how do they differently impact a company? What are some reasons a balance sheet may be unbalanced? And what is the difference between free cash flow and profit? Thank you for your time.